Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm always here to help you maximize your cash flow. You also know that I offer the best designed cash value life insurance policies, and we use these as a great place to store wealth, a nice safe place to supplement all of our other retirement efforts. They can be used for estate planning and building generational wealth with legacy gifts. There's all kinds of good reasons that we like to use cash value life insurance as a part of our overall portfolio. What I want to show you in this video is another one of my policies that I'm utilizing, how I'm going to utilize it or why we're utilizing it, so that you can see what's possible or get an idea if something like this might help as a place in your portfolio. So what we're going to look at today is my Guardian policy. This is an L99 product. If you saw my recent video of my wife's, you can check that out up here. Hers, we used the L95 product from Guardian. Mine is the L99 product from Guardian. There's some slight differences between the two. A little bit different cash growth in the early years, different cash growth in the later years. Overall, they function very similarly. And whether you go with one or the other is going to depend on what you're trying to do with it and what you expect to do with it. So in this case, we're using the L99 on mine, and I'm going to shift over to the in-force illustrations that I have. I'm going to show you the difference with an in-force illustration from a couple of years ago, where it's at today, how we funded it differently between that prior illustration and this illustration, and we'll talk a little bit about why we went with this particular product. Now, I have regular updates on my videos on all the different life insurance policies I own. We've got IULs. We've got whole life policies. In total, I think I have 8 policies right now between me, my wife, and my kids. And all of them serve a slightly different purpose, but it's kind of neat to keep up with those and see how they're doing. And they're all funded at slightly different levels too. But one key thing among all of them is they're all optimally designed for high cash value and minimal expenses. So let's jump into those illustrations and let's see how these things are doing. Before I get to the illustration, let's take a quick look at the status of where it's at today. So right now we can see this is the L99. It's called the Life Paid Up at 99. The base premium on this policy, $4,800 a year. We've got some term insurance blended in with it. This is how we get that nice low expense design. And then we have our paid up editions. This is my scheduled paid up editions. This is what I set it up as the minimum amount that I'm going to do each year. Generally, the plan in these types of policies is we're going to maximum fund them above and beyond that minimum amount. What I like to do when I'm designing these things is I like to set it up to where whatever that minimum is, you can do that no matter what. Even if you encounter some type of financial turbulence in your life, some financial emergency, you're still going to be able to cover that base. And then we design it with the flexibility that you can dump in a whole lot more than that up to whatever your goal is. In this case, we set it up with basically the ability to put in about $48,000 a year. So about 10 times the base. Okay. That's usually the types of designs that are optimized for early cash growth and the best value later on in life as well. So it's the best way to make use of these types of policies. So my base amount in total, $6,000 a year. Now I make monthly payments on that. I just have $512, I think, comes out every single month. And outside of that $512 that comes out every single month, because that's really easy for us to do, I have the ability to dump in a whole bunch extra. Okay. Well, let's take a look before we get into the extras. Let's see where our cash values are at. Now we're 5 years into this policy. I've just made my year 5 payments. The cash value of the base amount is only at $5,000. So we've put in 5 years of $4,800. We're still in the early beginning part of year 5, but we've essentially put in almost $25,000 in that base whole life. And of that, it's turned into about $5,448 of cash value. That's the reason we don't do all base designs when we're looking for high cash value early on. If I was to do an all base design and I was just putting in $4,800, I'm 5 years into it. I've only got $5,000 in cash value. That's not very much. Well, I do have some dividends that have paid in off of that as well. So we've got $6,000 in dividends that we've made off of that. So in total, I'd have about $11,000, almost $12,000 in cash value. We've paid in almost $25,000. So in year 5, we got about not quite 50% in cash value, maybe closer to 40%. Well, here in the paid up additions, we've got 270,000 in cash value. Okay, that's because I've been dumping in a lot extra. How much extra? Well, about 52,000 a year extra. So if we've got 5 years, I paid in 250,000 extra above and beyond. And we're just at the beginning of it, so I haven't earned extra on the extra 52 I paid in this year, right? But that's about 260,000, and we have over 100% of that back. That's pretty good. That's what we like to see because we have access to this cash value at any time. This is our line of credit. This is where we do our infinite banking from, okay? This is the death benefit amount that these numbers are buying. So I'm paying 165 this year for the term insurance, which is 232 in death benefit, 232,000 in death benefit. That goes down each year as I make these paid up additions because these paid up additions replace this death benefit here replaces some of that term insurance every single time I make extra paid up additions. And we'll see that happen when we move over to the in-force illustration. But it's something to keep an eye out for. This is the key to the efficient design. The term insurance is very cheap when we're young, and we dump in all of this extra money in order to replace it with permanent whole life with these paid up additions. And it gives us a much more efficient policy in the long run. So this is our current values. I do have loans outstanding. You can see that here. Here's the cost of our term insurance the year before. The cost of that term insurance is now $165. It went from $337 to $165. I got older. Normally your insurance will cost more, but we're buying less of it. So we end up spending less. That's why this policy gets more efficient year after year when we're dumping in those extra paid up additions. You can see my monthly payment, $512. Now, at some point, I'm going to switch this to an annual payment. I just haven't made any changes to it. But ultimately, I pay a little bit extra to do monthly as opposed to annually. Looks like around $72 for the year that I pay extra to do monthly. But it's easy. It just comes out automatically. And I have that set up for both mine and my wife's policies. So I haven't made any changes to that yet. At some point, when I want to become the most efficient with this, I'll switch it. But for now, we're just going to keep it at our monthly payments. You can see our limits here on the policy. This right here would list if I had any mech space available. So I'm currently maxing out. I'm putting in as up to the penny, as much as they will let me. And we can see that it is not a modified endowment contract. Now, modified endowment contract, that means it's no longer considered life insurance, and it's going to get taxed differently, whether we access it through the cash value through withdrawals or borrowing from it. It ends up being a last in, first out instead of a first in, first out. Normally, so when it is considered life insurance, it's a first in, first out. We can borrow against it. We're not tapping into any of the gains, so we don't pay any taxes, even if we're going to start withdrawing from it. We can do withdrawals up to our basis, so what we've paid into it. We can do that tax-free. And loans, we can do those tax-free as much as we want. Once it becomes a modified endowment contract, the loans become taxable because it's going to assume that you're borrowing from those gains, and they're going to charge you taxes on it. So we don't want to mech in almost every circumstance. There are some circumstances where mech is okay, but we're not going to be talking about that in this video. Now here with Guardian, we also have an index participation rider. It's not available in every state. It is available in most states. And what this does, it acts kind of like an IUL if I want it to. I can opt to allocate a percentage up to 100% to get credited based on growth in the S&P 500 up to a cap, instead of getting the dividend rate. Now, I don't use that in general. Our cap right now is 10.5%, but I don't use that. The floor is 4%. It's pretty good. But it essentially, to beat the 6% dividend rate that we're getting right now, or close to 6% dividend, we would need to hit that cap probably 3 out of 4 years, because it does cost 2% if we use this. So the net effect, if we use this, it doesn't cost me anything to not use it. But if I do use it, the net effect is my cap is essentially 8.5% and my floor is 2%. So when we take that into effect, we would, and the S&P in general is positive 3 out of 4 years. We would need those 3 positive years to hit the maximum in order to average around 6%, which is where our dividend is. So it doesn't really make sense to risk using this unless I want to try to time the market. And I'm not really interested in trying to time the market. Now, I added this rider because it doesn't cost me anything, and it's in my back pocket just in case I decide I want to use it. But If you own one of these policies and you have this and you're wondering, should I use it or shouldn't I use it? This is how I treat it. I don't plan to use it unless it might be some extreme circumstance where I'm going to try and time the market. But for the most part, the reason we get a whole life policy is for those growth guarantees and to get the dividend growth. Whole life companies, especially companies like Guardian, are really good at managing their bond portfolios, and we can expect really good dividends all the time. So this is meeting a part of my portfolio that I'm not really worrying about what's happening in the market. So we're going to keep it that way, and we're not going to be using this for the most part. But if I do, you're going to see it here. All right, let's check out the in-force illustration. So I've got two of them here. We've got one that I ran in December 14th, 2022, and we've got another one that was April 26th, 2024. You can see the details here. You're going to see the exact same details between here and here, except for this one is not showing a loan. At this point in time, I actually had this policy collateralized with a bank. They were using it at the time in 2022. Interest rates had not shot up yet. And so I was able to get loans from the bank somewhere in the 3% range, low 3% range. That changed when the interest rate environment went up. The Fed changed things. Rates went up over 6%. So I switched back to Guardian. So now I have a loan outstanding from Guardian. My loan rate, 5.6 some odd percent. That's for this particular product and when I bought it. These days, the loan rate from Guardian is fixed around 4.6%, I believe, 4.7, somewhere around there, 4.6, 4.7. So much better than what I could get borrowing from the bank. It's also easier to borrow from Guardian. I don't have to make monthly payments. I don't have to make interest payments. It's a lot more flexible. So my preferred place to borrow from is the insurance company. But if I get the chance for arbitrage, borrowing from a bank, we're going to look at it. I don't expect us to get back to that interest rate environment anytime soon. But that's what you're going to see is the difference here. When you look up here at the description, is that it shows a loan here. It doesn't show a loan here. I did have loans outstanding, but they were with a bank on this policy. All right, so let's look at the values. I'm going to highlight a couple of things that I want you to look at. We can see here, this is policy year 3, beginning of calendar year 2022. And here in our other one, we've got policy year 5, calendar year 2024. So those are going to be something you want to pay attention to. So when we're looking at the values, we know what we're comparing. We always want to try to compare apples to apples. What we're going to look at is how much am I illustrating going into the policy, because I'm actually able to fund it at a higher level than what we could illustrate in prior years. So we're going to look at that, and I'm going to walk you through what's happening. So we're back to the 2022 policy. Remember, I have this one as a loan through somebody else. So one of the things that we're going to do is we're going to put in that we're going to just pay that loan off. That way it's zeroed out here, and everything else is going to be the same. So both illustrations now show no loans going forward. And we're going to see just how the differences in funding change the values in the future on this. And this is how I track whether the policy is performing as expected, or if we're doing better or if we're doing worse. Now, dividend rates went up slightly between these two. We're talking like 0.1%. So not a big difference in dividend rates. That's not going to make the big difference when we see the cash values change. The difference is going to be, how did I actually fund this? And this is where it kind of gets me excited about how these policies work and what I'm able to do with it. So back to this one, this is 2022. We're going to look here at the funding level, and you can see that we're heavily funding it in these early years. And then we slow down. We drop down to basically just a minimal amount after year 7. That's because that term insurance is all gone at that point. When we optimize a design with Guardian, we're going to blend in some term insurance. And as long as we have that term insurance blended in, we can dump in up to 10 times. Well, we can dump in up to the MEC limit above and beyond that base amount. Well, once that term insurance is gone, once we've fully replaced it with paid up additions, we're just going to be limited to about that minimum amount. Okay, there might be a little bit more that we can do, but for illustration purposes, this is the easiest way to illustrate what's going on moving forward. So let's look at some specific years. This is basically the max that this would let me illustrate funding going in. And at age 65, we're actually going to take age 64, and we're going to look at the values. Note the columns up here. Here's our values. And at age 64, this is end of year value. So this would be the beginning of age 65. 884,961. This is 2002's in-force illustration. Let's hop over to 2024 and see what the projection is now. Okay, so this is our 2024 one. You can see here, beginning in policy year 5. And at age 64, now the projection, 924, 161. That's based on the current dividend rate. Our guaranteed values, let's look at the guaranteed values. The guaranteed values, current illustration, 728, 877. Back to 2022, guaranteed value, 700,000. 28,000 higher on the guaranteed values. On the non-guaranteed values, we went from 884 to 924. So we got 40,000 more. What's the difference in funding, right? That's the key here. What's the difference in funding? Maybe I'm just illustrating that we're putting in 40,000 extra dollars. Well, here's our funding amount. If we take policy year 5, the maximum that I'm able to actually fund this each year is right around 58,000. We can see that here in my report where we look at the MEC limits. Guardian will, under their current practice, regardless of what I can illustrate, they will let me fund it up to this MEC limit. So I have been able to fund it at 58,763.20 per year. So looking at this 2022 illustration, we can see that the software would let me show 52,000 going in. Well, we know I funded it higher than that because I put in the maximum that it would let me. In year 3, I was able to fund it at that maximum. We'd already funded it there. So in year 4, instead of the 52,000 that this is assuming, we actually funded it at 58,000. So there's an extra 6,000. And then in year 5, same thing. We actually funded it at 58,000 instead of 52. This is confusing, but we're going to hop back and forth. I'm going to try and keep you along here. If you have any questions about this, put them in the comments section below, and I'll do my best to answer. But hopefully you'll be able to keep up with this. So here's the actual funding that we're able to illustrate now. I'm able to illustrate the full funding here in policy year 5, and in year 6, I'm able to show 56.8. So the year before, or in 2022, I can only show 52,000 going in year 6 and 52,000 in year 5. So that's 6,000 here, 6,000 there, extra that I'm able to put in this illustration. But then in year 7, I can only show 19,200 going in. And then in year 8, we're down to 6,000. In this one, I'm showing 28,000 going in year 7, and then we're down to the 6,000. So let's add this up a little bit. The assumption is that I put in 6,000 less here in year 5, 6,000 less in year 6, and 9,000 more here in year 7, for a net difference of 12,000 minus 9, $3,000. So this, the 2024 illustration, the actual funding, and then these assumptions, is assuming I'm putting in an extra $3,000 by year 8. I'm just doing it quicker, I'm doing it sooner. I funded it quicker than putting in that 28,000 in year 7. Okay. Well, it stays at 6,000 in this illustration. This is our 2024. It stays at 6,000 up until age 62. Now, I had to reduce it after that. Otherwise, it might cause a MEC, according to the illustration software. So we dropped it down to just the base, and I could keep funding that base for a long time. So by the time we get to age 64, which was that number we were looking at, the value we were looking at 924, I've actually put in another 1,200 less in this year and 1,200 less in this year. That's 2,400 less that I funded it at. We're almost even funding now by the end of age 64. I funded it at $600 more? 58.7 is what I'm able to put into it. Actually, so that's more than 6,000. It's actually 6,700 for each of those first 2 years, which gets us up to 13.4, figure 13.5. We put in 13.5 minus the 9,000 on the other one. We're at 4,500 minus 2,400. So we're actually 2,100. We funded this one at 2,100 higher in this 2024 illustration. We funded it 2,100 higher than our 22 illustration. But the value is $40,000 higher by the time we get to age 64. We're $40,000 higher. 884 compared to 924. That's pretty good. And I just had to fund it a little bit quicker. Now, if we go farther out, every single year I'm putting in 1,200 less than in the other illustration. So if we go down to, or let's look at 74, this is 10 years later. Now we're at 1.44 million with the 2024 illustration. And in 2022, 1.37 million. It's about $63,000 higher. The only difference was 2 different years of funding. But I've also put in 10 more years of $1,200 less. So I put in $12,000 less. So the actual difference between what we funded it at and the cash growth is not 63,000. It's actually about 75,000. That's pretty good. I'm pretty happy with that. Where's our death benefit at by then? 2.128 million. And in 2024, 2.2. That's what we like to see. This is why we're funding it the way that we do it. The most efficient way to fund this is to max fund it. Now, if I was unable to max fund it, does it ruin the policy? Does it blow it up? No. I just pay a little bit more for that term insurance for an extra, for some extra years until I burn it off or cancel it. If I never pay that extra, it never burns off that term insurance, I can just cancel it before that term insurance gets expensive. That's okay. And I still get the death benefit coverage just in case tragedy happens. So there are ways that we can mitigate if we have to change our funding method and we're unable to max fund it. We don't have to be able to max fund it. My original design wasn't max funding it. My original design was showing us funding it at 52, not 58. Let's take a quick look at what the side-by-side looks like. So here's the side-by-side on our cash values at age 65, which in the illustration reflects end of year 64. So 65, 75, and 85. And remember, in this design, this is our 2024, we funded it lower. By the time we get to age 75, we funded it lower by about 12,000. By 85, by about 24,000. We funded it lower. Then the projection. These are the exact same policies. This is just what it projected at that time. So the projection has gone up significantly because of how we were able to fund it. I really appreciate what's going on inside these policies as a part of the safe aspect of my overall investment portfolio. I really don't have to worry about what's going on in this policy. And that cash value works just like a line of credit. I can use it anytime I need to. I know what the cost is. It's fixed up until age 65. It's fixed at like 5.6%. And then after age 65, it'll drop down to 4% or so. And I get an offsetting credit. Guardian's a direct recognition carrier. That means instead of getting the dividend rate, I'm going to get an offsetting credit based on the loan cost. It's predictable. And when I'm borrowing, whether I'm borrowing or not, that cash value is still going to grow and compound in the background. So I don't even think about when I'm borrowing these things, I don't think about the impact on the growth. It may or may not impact the growth positively or negatively by a little bit, depending on where the dividend rate's at. Where I treat it as another line of credit. I have a home equity line of credit I can borrow from at 9%. I have a life insurance policy I could borrow at 5.6%. Now my home equity line of credit, before the rates shot up, my home equity line of credit was somewhere in the 6% range. There were special rates down in the 2 and 3% rate range that some people were able to get. But those rates are variable. Having this always accessible to me at 5% or 5.6%, along with my other life insurance policies, those are other lines of credit that we're creating that are accessible to us at 5%. It gives us more tools in our tool bag if we have a need for capital to go do some other investing or to fund our retirement, right? We have access to that capital. So we're going to store our equity inside these policies and we're going to tap into it when we need it at that fixed cost. We know what that's going to be when we start the policy. I'm pretty happy with the way that this is performing. Check out my other policy update videos if you want to see how my IULs are doing, if you want to see how my other whole life policies are doing. Coming up soon, I'm going to have an update on my Mass Mutual policy. My Mass Mutual policy is a non-direct recognition company. Is there a big difference between direct recognition and non-direct recognition? Not that I can see. I think for the most part, when we're trying to decide between the two, it's really going to come down to what type of flexibility do you want or need in order to fund it the way that you're hoping to fund it. Now, for me, Guardian's flexibility means I'm able to do a very large policy because I didn't have to commit to very much. I only had to commit to $500 a month, but I was able to dump in throughout the rest of the year. Anytime I want, I could dump in a whole bunch extra up to that 58,000. And if I didn't fund it up to that 58,000 last year, I could catch up and fund it at 100,000 this year, right? If I only put in the 6,000 minimum last year, I could put over 100,000 in this year. So there's a lot of flexibility when it comes to that funding, that's one of the reasons why I have this Guardian policy designed the way it is at that high funding level. Because I anticipated being able to fund it at that high level. Didn't know if I was going to be able to or not. So I don't want to make a commitment. I don't want to be with a carrier that says, hey, if you want to put in $58,000 a year, you need to send in a design that has that commitment of $58,000 a year. And if you don't give us $58,000, your policy could lapse. I don't want that kind of design. I don't want that kind of pressure. My policies, the anniversary dates are right around tax time. That makes it really hard to know if I'm actually going to have enough cash around tax time, or if I have to be sending this money into the IRS, or if I have to be funding my retirement account. So I need that flexibility where I just fund it at the minimum amount. And if I get the ability, I'll fund it at the higher level. Hope that helps you understand these policies a little bit better. If you have any questions, or if you want to see something designed specifically for you, my scheduling link is in the description below. It's a Calendly. You can hop in there. You can choose a time slot. I do 20-minute free consultations with anybody, whether you're a potential client, whether you have a policy you want me to review, or an illustration you got from somebody else you want me to review, or even if you're another agent and you want to just talk about stuff, figure out how maybe you can improve what you're doing and what you're offering your clients. Feel free to schedule a meeting with me. Happy to chat with all of you guys. And with that, we'll be back next time when I think we'll have some more information that might be of value to you. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.